Welcome back to this channel. This is Unfiltered Forex with me, Clement, and I am here to talk about the FOMC press conference and not just the FOMC event that's coming. This is the monetary policy decision, the interest rate decision itself, the statement, and the economic projections, and yeah, the press conference. So in this video, we're just going to break down what to expect in this coming meeting and the things that will the market will react to. What are, of course, stealing the spotlight is interest rate projections. If the Fed is going to say they're going to keep rates high for much longer than the market thinks, or maybe even go higher than the market expects. So yeah, that all that we're going to just go into the details and see what is likely to happen. So currently the Fed is at 5.5 basis points, 5.5%. So that's 550 basis points, which is quite a lot of hikes considering yeah, they just came from zero a few months ago. So yeah, this is the fastest tightening cycle seen in a while. Yeah. So they hiked rates. Yeah, they hiked on July. Yeah, on July during the July meeting. That's when they hiked by 25 basis points to bring the current target range to yeah 5.25 to 5.5 percentage points. So yeah, this is how the current probabilities are looking like. 99 There's a 99% chance, or rather 99% of market participants are expecting a pause. Yeah, this is the current range. 99% are expecting a pause and only 1% are seeing a hike. Probability of a rate cut, 0. Looking at the table of probabilities, this is where now we get the deeper look at what the market is really expecting. I don't know, let's make this bigger. Yeah, I believe this is clear. So this is the table. For those of you who don't know, I think I can spare some time and say what this table means. So this is just a table of probabilities, and what you've seen back here at the current probabilities of 99% and 1% are these ones here. So this is a probability for the current, most the meeting that is coming in the nearest, which is tomorrow, 9th, no, not 9th, 20th September 2023 meeting date. For this meeting, these are the probabilities. These are 99% of market participants are expecting a pause because this is the current target range. 1% are expecting a hike. This is a 25 basis point hike, and this is a 25 basis point rate cut. So probability of a rate cut is 0 in this meeting. In the next meeting, the November meeting, 69% of market participants are expecting a pause and 30% are expecting a rate hike at that time. The December meeting was low probability of rate hike, but it's quite significant for now. Yeah, this is the highest here. Yeah, so it's very likely that, according to this, it's very likely that during the December meeting, there will be a rate hike. Yeah, moving on. You can see now we go to 2024. This is the January meeting, March meeting, May meeting. So all these meetings for next year, the market is expecting a pause. The market is expecting the first rate cut to come in mid next year. This is the July meeting. No, June. This is the June meeting. This is where the market is expecting the first rate cut, 25 basis points, and then from there on, three rate cuts next year, bringing the target range to from 4.5 between 450 to 475 basis points. Yeah, so these are the current probabilities for 2024. You can see for the first half, the market is not expecting any any rate cut until yeah, this is mid June. That's when the market is expecting the first rate cut to come, and then a pause in the next meeting, and then another cut in the next meeting, and then a pause in the next meeting, and then a cut in the final meeting. So yeah, that's basically the interpretation of what this table is showing. So currently, this is where we are now. Tomorrow's meeting, 99% chance of pause, 1% chance of a rate hike. So it's obvious it's very likely to be a pause. And that's not going to affect the market in any way currently because we saw that coming. The market saw that coming. It has already been priced in. So what's going to affect the market really is these is these other expectations, how they're going to shift, especially from the December meeting going forward, how these probabilities are going to change. So, yeah, now let's go to the Fed website and let's see what we're talking about the calendar. No, yeah, here we are. This is the Federal Reserve website, the 2023 FOMC meetings, and here we are, September meeting. So, every meeting with a star here. You can see June star, March there's a star. Every meeting that has this star is supposed to mean there was an SEP. You can see projection materials. Another one June, projection materials. Another one September. There will also be projection materials once, of course, it is released. So currently, we will have to refer to the June SEP because this is the one. This is the latest one. So yeah, HTML. Let's not look at the PDF for now. So yeah, this is now the summary of economic projections. You can see here. Let me put this. You see here summary of economic projection in conjunction with blah blah blah. So this table is what is very important. This table is now the core. I can say that the core of the SEP. These are now the projections of the Fed. This is what the Fed thinks the economy is going to do in the near term and long term future, even. So, mhm, you can see here, this is the variable column, and there's a change in GDP and unemployment rate, inflation, PCE, core PCE, and then federal funds rates. So, this federal funds rate is the most important one. Yeah, this target range is what's most important because these other ones are guesses. Yeah, this is just the best guess of what the Fed members think the economy is going to do. It's not entirely useless, and I'll explain why just in a bit. So this is the most important one because this is the one the Fed controls directly. If they say they're going to hike rates, they just hike. That's totally within their control and that's their job. But these other ones, inflation expectations, unemployment rates, what they do really is they give the markets some insights on what the Fed is likely to do. Let's look at the PCE inflation, for example. Remember, this is the June SEP. So these are the June projections for 2023. The, they were expecting PCE inflation to go to 3.2% to end the year at around 3.2%. 2024, 2.5%. So That's basically the Fed saying they don't think inflation will be under control this year or even next year because the target is 2% and 2% means 2%. So, yeah, according to how this estimate is going to shift, if the Fed updates this and says they just think PCE inflation next year will be 3%, right? They just say 3%. Of course, that's going to be extremely what extremely bullish for the dollar index, bearish for stocks and currencies quoted against the dollar. So yeah, this if they think if the Fed says they're thinking inflation is going to be stubborn even next year, that of course means it's very likely that there will be changes here. So yeah, but since this whole report is coming out at the same time, this is where just the market decides to look at. You can see here there's the March projection, 5.1. This is the terminal rate, all right? This is the median. This is the central tendency range. For these numbers, you have to be familiar with statistics concepts for you to kind of just go through this easily. But in case you're having trouble, just focus on this one, the median. The March projection was 5.1, meaning at that time during March, the Fed thought they would close the year at 5.1. That will be the interest rates by the end of the year, 5.1. But in June, they updated this and said, well, now we think 5.6 is where the rate will be at the end of the year. And then moving on, this is 2024. So for 2024, the Fed is saying in March, the Fed said, we think we're going to close the year 2024 at 4.3%. And then in the June update, they said they think they're going to close the year at 4.6%. The following year, 2024, at 4.6%. So these other ones you can ignore them. Just focus on these two. Yeah. So as you can see, they they kind of they kind of they raised the terminal rate. The terminal rate is the top, the highest, the highest rate. Like let's say where they planning to stop hiking rates. That's the terminal rate. So if this is showing 5.6%, then of course that means this was the terminal rate at the time during the June meeting, sorry, the June meeting, this was the terminal rate projected. But currently, of course, this means one more hike because where we are now is between 5.25 to 5.5, right? So the median for that is 5.3, I think. Yeah, the median for that is 5.3. So we're at 5.3 and they're projecting that we're likely to end the year at 5.6. So that of course means one more hike is coming. Moving on. Okay, now we have to talk about what this means for the markets and the various scenarios that this is likely to play out. Allow me to switch to to my to my white pad here. Yeah, this is where we are now. This is what we'll be talking about for some time. So as you can see first, it's the same table. This is the March projection, this is the June projection, and we're waiting for the September projection. It's red because they increased the target range. In this case, yeah, if they project a higher terminal rate, that of course is bearish for the market. So yeah, we're going to use that color code. So the projection right now is 5.6%. So suppose update this and say, they think the terminal rate is going to be at, no, they just leave this at 5.6% for September projection. That means they're still expecting one more hike this year. Yeah, that means they're still expecting one more hike this year, probably November or December. November. That's the most likely time I think they will hike. That's according to me. So if they say 5.6, that's kind of neutral, and the market is going to say, well, we saw this coming. They have already said this in the previous report. So another thing that's kind of likely to happen is, suppose they say they're going to, they update the terminal rate and say they think they'll end the year at 5.8 or 5.9. Suppose they say they think they're going to end the year at 5.9. Hmm, if the current if the current percent is 5.3, for us to go from 5.3 to 5.9, that's two more hikes left. And see, this is one more, so we get to 5.6, and then another one, so we get to 5.9. So if they come out and say 5.9, that means they're projecting two more hikes for this year. And you can see we only have two meetings left. So that's going to be bearish for the markets, of course. It's going to be bearish for the markets. But there's a special case where mm, I think you watched the video where I talked about the Bank of England rate hike, and probably when you watched the video I did on the weekly recap, where I talked about the ECB rate hike just last week, and we said there is a time when the central bank, they can hike the interest rate, and they can hike the interest rate and the currency falls. Why is that? Because of interest rate expectations. If a central bank is seen to be doing front loading, then it kind of reduces the effect of those rate increments. So in this case, if the Fed says they're going to hike, let me let me let me let me draw this better. If the Fed says they're going to hike by two more hikes this year, and then if they say they're doing two more hikes this year, and then next year they said they'll start rate cuts as soon as maybe March. That's when the rate cuts will likely start. If they say that, that of course is going to bring this what do you call it, confusion in the market, since hey, if you're going to hike, first, this is bad news, right? This is going to be bearish. But if they say they'll start cutting rates as soon as March next year, that of course is going to be extremely good news for the markets. So it's a very, what do you call it, a very unclear situation we are in right now, because there is no talk of a pivot yet. But if it gets introduced, if Jerome, or if just the statement hints at cutting rates earlier than the market expects, that of course is going to be extremely bullish for these markets. That's going to be good news. Something else you need to look out for is this other one, the 2024 projections. Now let's compare to where these projections to where we are currently. No, this is the one. This is where we are at now. If these probabilities remain as constant as they are right now, that's pretty good. That's not going to be a bad thing. That's not going to be exactly a good thing. what the market is looking out for is these rate cuts and how soon they will start. Currently, rate cuts are expected to start June next year, and yeah, and continue till December next year. That's four rate cuts. No, that's three rate cuts. That's three rate cuts. So the market is just waiting to see what the Fed is going to say. And in general, it's very hard to tell what's going to happen. But let me just look at the chart. Maybe we'll see something. Here we are. This is the dollar index daily chart. So what we're looking at here is the trend. That you can see there's a consistent uptrend here, and it seems very strong. Of course, since the Fed doesn't seem they're going to pause rates anytime soon. So the current market sentiment is likely that the outcome of that FOMC meeting and all of that is likely to be okay. There's three outcomes. There's three net effects likely to happen. One is bullish, the other one is bearish, and then the neutral. There's a neutral effect that's likely to happen. So if it's neutral, like if there's no major change in market expectations, that's going to be bullish for this one. The trend is just going to continue. If it's going to be if it's going to be bearish for the markets, like the Fed says they are raising interest rate expectations and they don't think they're going to rate cuts from June next year, probably from September. That's going to be extremely bullish for the dollar index and bearish for other assets. But if they say they're pricing in, they're starting to see rate cuts coming into play very soon. That's of course going to be bearish for the dollar index and bullish for the markets, the stock market and other currencies quoted against the dollar. So yeah, that was it for that one. If I look down here to this, let's go lower a bit to the smaller time frame. Uh-huh. So looking at this, it's kind of something like a flag, like a bull flag, and you know how this plays out usually. It's a buy, yeah. And let's just wait for a good entry and then probably just think about going long. It's very likely that this is going to shoot from the technical perspective. Looking at this, it's looking like it's forming a retracement and then the uptrend continues. That's what it has been doing over the past 3 months since since when since yeah since late July, since mid July in fact. It started rising, small retracement, continue rising, small retracement rise, small retracement rise. Yeah, it's just another small retracement probably, and then the upward trend continues. So that was it for this video. I hope you've understood something new, and yeah, we'll see you again when it comes to the recap of these events.